Hello and welcome. Good afternoon. Thank you for joining today's webinar. We're super excited about what we're presenting today. Traditionally we're doing the quarterly economic updates, but for this webinar, we really wanted to do more of a detailed portfolio review. So folks, hope you really enjoy today's webinar. As far as presenters today, we have myself. My name is Paolo LaPietra. I'm a certified financial planner and also the director of portfolio strategy. And I am joined by Edward Wilhelm and Casey Bird, two of our senior portfolio traders. So let's talk about agenda. I'm going to be kicking things off talking about holdings and allocation, what that means from a performance so far this year, and look at some other time periods as well. Then Ed's going to take over and talk about our first AI trade that we made back in November. And then Casey's going to walk us through the second leg of the AI trade that we've had this year. And then I will kind of take things back over and just summarize everything that we've done so far in year to date. So let's kick off by looking at our equity holdings. And that's what we're seeing right here on the left-hand side of the screen. You're seeing 12 of our equity positions, and that's made up of ETFs in both individual stocks. And what these positions do is they give us broad market exposure, really relying and laying into some of our dividend and quality factors that we've had within our portfolios for a couple of years. But some of our more targeted thematic positions. And that's what we're going to spend the majority of today's webinar talking about is these new positions. We've actually added 5 and we've dialed back on some of those, but those are going to be the highlight of today's webinar. And again, those are the 12 positions that currently reside within our equity sleeve. So let's also talk about our allocation breakdown. So we're going to be talking about 2 different parts here. On the left-hand side of this screen, we're going to be looking at what's called the style box. So that just breaks down how much of your portfolio is made up of either large cap companies, mid-cap companies, or small cap companies. And what we'll see here is the majority of our portfolio still resides within the large cap space, and that's by design. Over the last 15 years, plus, really a lot of the performance that we've been seeing in the markets have been in the large cap space, particularly in the large cap growth space as well. So that's where we have the lion's share of the portfolio, and that's by design. But where I also want to kind of bring our eyes to is the mid cap and the small cap space. So you'll see that we have some, significant mid-cap exposure, but very little small cap exposure. And again, the reason being is we think the small cap landscape has changed fundamentally over the last 10 years or so. A lot of the best and the highest prospects out of the small cap space, they're just staying private for longer, making more of the mid-cap space more attractive. So we've really just been concentrating a lot of our market cap style investing in the mid-cap space. And then, obviously the large cap space. Then over to the right, we're looking at the sector breakdown, and hopefully this doesn't come as a surprise. We continue to have technology as our main concentration within our sector breakdowns. And again, this is nothing new. We've certainly ramped this up with this whole AI trade that's going on. But Steve has been a pioneer, investing in the technology space, for the last 30 plus years. And that is continuing to be an overweight in our portfolios. And you'll see that's exactly why we continue to be an outperformer in that space. So let's talk about some performance. We're actually going to be looking at 3 different time periods on this screen. And this is for our qualified portfolios, right? So this is, of our IRAs, Roth IRA, traditional IRA, anything that is, pre-tax where we don't have to worry about generating any capital gains. And we'll see on the left, year to date, our qualified models are up 14.2%. Now, that's really important because year to date, the S&P 500 is only up 7.8%. So our portfolio so far this year are outperforming by 6.4%. It's some very, very strong performance so far this year. Then we could see on the 1-year trailing, so 1 year prior, we're up 32.6% in our qualified all equity model. And that's outperforming the S&P 500 by 5.4% over that time. And then the last one we want to take a look at is going back to the November 21st of last year. And that's important because that was our first AI trade to update the models. And you'll see that since then, our qualified all equity model is up 18.3%. And again, that's an outperformance over the S&P 500 by 5.5%. So again, some really strong performance over all three periods. One last way I just want to, really show you guys of exactly where this performance is coming from is looking at the position performance. So this is looking at all 12 equity positions within our equity sleeve, and it's showing the year-to-date performance. And that's that middle column. And then all the way to the right, we could see the performance against the S&P 500. So if it's in blue, that means it's an outperformance. If it's gray, that means it's neutral. And if it's red, there's been some underperformance this year. And what you'll see is the real driver performance so far this year, and what we're really going to get into detail with, is two of our thematic AI trades that we've made so far. And the first one is SMH. That's up 52.3% so far this year. That's outperforming the S&P 500 by almost 45%. And the next position is DRAM. You see an asterisk there because we actually added that back in April. And since we added it on April 14th, it's up 44.5%. And that's outperforming the S&P 500 by almost 40% during that time. So some really, really strong performance through our AI tactical trades. And that's what we're going to get into in the next part of the presentation. So in the next part, I'm going to pass it off to Ed.
Thanks, Paolo. I'm going to be covering the first part of our AI trade, specifically our tactical rotation back in November of 2025. November gave us the first real shake in the AI trade. The S&P 500 pulled back about 5% into mid-November, and the selling was concentrated in the names that had led all year. NVIDIA, Oracle, Microsoft were all under pressure. The narrative was that AI capital spending had gotten circular and the whole build-out was at risk. We saw it a little differently. We view the AI story as a structural shift, not a trade, and the market was offering it at a discount. So on the 21st of November, we trimmed some of our defensive and dividend exposure within our model and added weight where the sell-off was deepest. Semiconductors through SMH and nuclear through NLR. We also wanted to take advantage of the volatility in crypto, so we included an allocation to Bitcoin via HODL. 6 months later, SMH is up over 65%, and we clipped NLR at a 20% profit. Let's talk about SMH. As the foundation of our AI exposure, SMH has done exactly what we asked it to, up 66% since we added it in November, while the broader market has returned about 13% over the same stretch. Semiconductor chips sit underneath everything else in the AI stack. The models, the applications, the cloud platforms, all of it run on chips. So when companies like Microsoft, Meta, and Google commit another $725 billion to AI infrastructure, those dollars flow straight through to the companies inside this ETF. And the earnings have followed. Global chip sales were up nearly 80% year over year in March, and the industry is on pace to cross $1 trillion in revenue this year. The names in here are putting up real numbers and continue to justify their valuations. Now, NLR. NLR was on the energy side of the trade, and the thesis was simple. AI data centers need an enormous amount of power, and nuclear is the only source that can deliver it at scale without carbon. Layer in a more friendly administration on permitting and licensing, and the setup looked very compelling. And the trade worked. We bought in November and sold in April for about a 20% gain. The reason we exited rather than ride it further is that the story is still ahead of the earnings. The capacity isn't online yet, the cash flows haven't shown up in a meaningful way, and we still like the theme long term, but right now we'd rather have the capital working in places where the numbers are already there. And last but not least, let's talk Bitcoin. HODL has been the most volatile piece of the November trade. We added it as a digital asset leg of our innovation theme alongside SMH and NLR. It worked early, sold off hard into the spring, and has now recovered most of that drawdown, up almost 10% in the last month. What gives us conviction to stay with the position is that the institutional adoption story. Last month, Morgan Stanley, the biggest wealth platform in the country at over 8 trillion in assets, is now formally recommending a 1 to 4% allocation for their clients. That's a structural shift, not a fad. Bitcoin is now being treated like a normal portfolio holding by the most established players in wealth management. That kind of slow moving, durable demand is what gives this position a reason to be there. Now I'm going to pass it off to Casey.
Thanks, Ed. The first part of the second leg of our AI trade was our NLR exit. The dark blue line on the graph in front of you represents NLR, which we bought in November of 2025 as the first leg of our AI themed trade. We exited last month for a gain of 16.9%, while the S&P 500, represented by the gray line at the bottom, was up 5.9% during that same time period. The dashed line shows where NLR sits today had we held on to it. We took our NLR gains and rotated directly into a new ETF called DRAM. Our conviction in nuclear energy as a long-term AI power source hasn't changed, but as a committee, we saw a stronger near-term opportunity in hardware and memory. That decision has played out extremely well. The yellow line on the chart is DRAM, up over 44.5% since we entered it last month, compared to the S&P 500 in gray, up just 7% over that same time period. I'll walk through DRAM in detail in a couple of slides. The second leg of this AI trade was we added Microsoft to the portfolio. When we bought it last month, Microsoft had a very compelling valuation entry point, and I'll cover the details on the next slide. To fund Microsoft, we fully exited GEOCT, which was our buffered ETF that had a solid 2-year run within the portfolio. We also trimmed SCHD by 1%. At that time, SCHD was up nearly 13% year to date, holding up well as a defensive position in the portfolio. We captured those gains and redeployed those funds into a higher convicted area in the market. At our entry point, Microsoft was down 18.5% year to date and nearly 30% off of its all-time highs. We view that sell-off as a rotation story, not a fundamental issue. The market had been moving out of software and into hardware, and those returns in SMH and DRAM's underlying holdings support that thesis directly. One concern circulating among some investors, not us, is Microsoft's capital spending. They've committed roughly $100 billion in 2026 towards AI infrastructure build-out. We see that as a huge plus, not a flaw. AI is not going anywhere, and any company that's not deploying capital to build, integrate, or leverage it today will fall behind. Microsoft is making the right bet at the right scale. The earnings picture reinforces our conviction. In Q1 2026, Microsoft reported 18% year-over-year revenue growth, 40% growth on the cloud side of the business, and net margins of 36%. These aren't numbers of a company in trouble. They're the numbers of a company that was simply on sale. And it's only a matter of time before Microsoft reaches those all-time highs again. And when it does, it's going to be a beautiful thing for the portfolio. Our conviction in the hardware side of the AI has been building for months. 2 South Korean companies, SK Hynix and Samsung, have been on our watch list for some time. The challenge is finding the right investment vehicle. No hardware-themed ETF held either name until DRAM. While researching these 2 companies, we came across a new ETF preparing to launch called DRAM, managed by Roundhill Investments. Once it went live on April 2nd of this year, we called Roundhill's portfolio management team directly to walk through their outlook and better understand how the fund is managed. After that call, the committee was fully aligned and we moved with absolute conviction. We were among the first firms to invest in DRAM when the fund's AUM was just $400 million on April 14th. Today, it sits nearly $7 billion AUM, making it one of the fastest growing ETFs on record. And the earnings back that up. SK Hynix and Samsung both reported Q1 2026 earnings a few weeks ago. SK Hynix posted revenue of 198% year over year, and Samsung was up 69% year over year. Both came with strong forward guidance with no signs of slowing. Across the entire hardware sector, demand continues to outpace inventory. That dynamic will continue record growth and expanding margins going forward. On the graph in front of you, the dark blue line is DRAM. Again, up 44.5% over the past month since we've entered the position. To put that into perspective, the gray line is the S&P 500, up roughly 7% over that same time period. Now, I'm going to turn it back over to Paolo for closing remarks.
Thank you, Casey. So, folks, a lot of great information here. And again, I want to say how, a little bit different than what we normally do. A lot of times we're looking at an economic update. So, as always, would love to get any sort of feedback that you would have on today's presentation if you want to see more of this, or maybe there's something in the portfolio that you're interested in that we're not covering. Would love to hear from you. But to summarize what we discussed today, outperformance has really been super strong in our qualified models, and that's what we're seeing on the left-hand side of this slide, outperforming by 6.4% so far this year over the S&P 500, and how that's powered, and that's by active management, right? So those are those two thematic trades that we made, adding in 5 new positions through that time, and that's really important, especially with the volatility that we saw, all throughout this year, but more so within, end of March and early April. And our positioning really being thematic led, right? Want to make sure that we're really relying upon the AI trade and dissecting the AI trade and following the money on where durable earnings are and where the profitability is, because that is going to be the long-term growth that we're looking for. So, folks, I really want to just say thank you for spending the last 20 minutes with us. As always, reach out to us with any questions on any of the positioning or the trades that we talked about, or, if this fits into your broader plan, reach out to the advisor that you work with. We would love to hear from you. And again, any feedback that you have on today's presentation, we would also love to hear from you. So thank you so much for spending your afternoon with us for a little bit, and I hope you have a wonderful rest of your day.